But none of that really is inside of his book. His book is a very solid foundation in psychology. In fact, I borrowed from some of the concepts in that book for my psychology section, among other sources. And really, that's a good enough start as any. There are, almost an unlimited number of books that are written about the financial markets. So, those are good places to start. Also, I would suggest books by Larry Pesavento. He's actually here in Arizona and is a friend of mine. Last name is Pesavento, Larry. But also some of the classics. I might be spelling this wrong, but Reminiscences of a Stock Operator. I would also suggest Wyckoff. He's got some excellent books, really about the structure of the market. In fact, I started studying Wyckoff, I don't even know how long ago, and how he approaches the market and some of his market theories. These have been borrowed from. In fact, there's a college course in San Francisco that you can go to actually learn some of his strategies. And those are really the basics. It'll give you a view of other traders, a view of psychology. Pesavento goes into Fibonacci analysis. Wyckoff goes into market structure and how the professionals actually think. A couple of books that are, one book that's a good read at least is called Mad Bull, and that's by Marty Schwartz. That's a good read. It's Marty Schwartz, basically like an autobiography. Again, it'll give you an insight into what it takes to be a trader, and some of the things that this guy does were just absolutely amazing in terms of trading competitions and really being able to take risks is what it boils down to. And that, this just occurred to me. One of the things that you've got to get good at is taking risks and being okay with taking risks. And I really think that once you get good at taking risks, and if you get good at taking risks and you're smart at which risks you're taking, that's a very good combination for a trader. Okay, and then we have a comment that MetaTrader 4 does do rectangles. That's actually good news. And then also, it seems like you never reference news as a contributor to market moves. Why is this, since news is symptoms of fundamentals and definitely affects price? That's an age-old argument. The pure technician is going to say, well, hey, the technicals are going to give you a warning sign to the news. The fundamentalist is going to say, no, the fundamentals override technicals. The reason why I don't reference them specifically is because the calendar is up on the website, and quite frankly, in daily videos and whatnot, quite often I just forget about it because I'm not thinking about that in my analysis. It's in part of my checklist. In fact, I'm looking at two pieces of paper, my daily checklist, and then the actual calendar that I post on the website. So it is something that I look at. I will make an effort to talk about news announcements a little bit more consistently in my daily videos. But it was in the course. So you can't say I never reference news, and I do talk about it in the daily videos occasionally. But I agree, it's not quite often enough. So I will get better at doing that. Okay, I've just been trading the London session, and I have this dilemma regarding the lot you leave to run. How to handle the stop loss to get the benefit of leading 20% to run during the London session, how soon to move it up to break even. At this London open time, is there any way of telling if they are giving us a sneak attack and it is then reversing, or if the reversal is a little dipper and the market will continue?